Hey guys, John from Gutenberg Research here, and in this video I'm going to take you through our Alibaba Group earnings model ahead of this week's release, and I'm going to show you how I've calibrated that model to meet the consensus estimates heading into the release. That way we can update the results as soon as we get them and then see instantly what the impact on share valuation is. But before we get into that, I just want to show you some changes that we made to our model. So in the September quarter, so last quarter, management stopped disclosing GMV rates. So we used to use GMV and monetization rates to project out future period revenue for the China retail segment, and we would split that between mobile and desktop users. But now, since they don't give GMV, we had to come up with a new methodology of quantifying monetization. And China retail is definitely the bulk of earnings. So for the other segments, we just apply a quarter-over-quarter growth rate, and we do something a little bit interesting with the cloud computing segment, which I'll get into a little bit later. But for China retail, we had to come up with something. So we're using these two metrics that they've given us here. They give China retail revenue, so that's total both mobile and desktop, divided by annual active buyers. And they give retail mobile revenue divided by mobile active users. So if you think about these two metrics, they're a little bit difficult because if we're going to try and project out one quarter at a time, you're kind of using an annual number to get to one quarter's revenue in the case of annual China retail revenue to annual active buyers. And then in this case, we're using a monthly active user number to get to a total quarterly revenue number for mobile. So let me show you how we dealt with this in our model. So if you'd like to follow along, you can download it for free. It's available on our webpage, gutenbergresearch.com. Click on the Alibaba model, and then you just click this icon to download. And now with these new segments that they added last quarter and the lack of a GMV rate, it's gotten a little bit more complex and a little difficult to model out into the future periods, but I will show you what we did. So I'm going to freeze the panes here. And you'll notice this is a bit different from our other models because we've got two currencies to deal with here. So we have RMB, and we model operations and earnings in RMB, and then we translate it back to USD for valuation purposes. And the format is the same. So in the top section, we have the income statement, and below that we have the segment details. So the segment assumptions in the blue cells are what's driving the income statement up above. And the columns shaded in dark gray represent historic actual results, and then the light gray sections represent our future forecast period. So this December quarter would be the next quarter that's going to be released this week. And anywhere you see orange cells, that means we've calibrated our results to meet the consensus estimates. So let me show you in the segment details how this works. So this section that I've shaded in blue off on the left is the China retail segment. So I've broken that out between mobile and desktop. And then I have a couple of statistics here. So these are the two stats from the earnings presentation. So annual active buyers and mobile active users. So that shows up right here. And then we have total China retail, but this is the more important piece. So you can see in the past we used to use mobile GMV and China retail mobile GMV percentage and a monetization rate to get back to total earnings for mobile. And we did the same thing for desktop. So we can't do that any longer. So what I've done for mobile is I just take the total monthly active users and I divide the mobile revenue by the monthly active users. So I'm just saying revenue for the quarter per user. So this would be 41 RMB per monthly active user for the quarter. And then I project those rates out into the future, and I use the historic results to inform my decision of what that should be in the future. So if you take the September to December quarter of last year, we saw an increase of what percentage is this? This is about 60% or so. Yeah, 57%. So I applied a similar percentage going from the September quarter, so that would be last quarter, to the December quarter of next year. And I kind of held those percentages somewhat constant for the next 12 months. And then for the desktop, there really isn't a monthly active users. We do have annual active buyers. So I just took, in the historic periods, I just divided the desktop revenue, so that excludes the mobile revenue, by the total annual active buyers. So I come up with quarterly revenue per average annual active buyers by the end of the quarter. And then I apply similar growth rates, kind of like what I did with the mobile active revenue per mobile active user estimate. So the model obviously is very sensitive to these changes, and it's also sensitive to your estimates for annual active buyers and mobile monthly active users. And for the users, I basically just have a steady increase because there's not a lot of seasonality there. I mean, the December quarter tends to be a bit higher, but I brought most of that seasonality into the revenue per user estimates. But if you prefer, if you think that they're going to grow and have like a significant increase in active users, you could change these blue cells and see what the impact is on total revenue. So that is the bulk of earnings coming from China retail segment, but they have all these other segments. And for all of these, I didn't really, most of them are not huge contributors to earnings, so I didn't really want to change things too much or get too complex with the estimates. So I just applied quarter-over-quarter growth rates, and I used the growth rates for prior quarters for the segments that existed and have some history to them to inform the decision of what the revenue would look like in future periods. The only one that's a little bit different is the cloud computing segment. So they started to disclose the total cloud customers in thousands right here. So I just do a simple division of revenue by customers to get a total revenue per customer, and then I just use revenue per customer and estimates of customers for future periods to estimate future period revenue. So other than that, we have some that basically just gets us to the top line revenue estimate up here. So it gets it in RMB, and then we've got an FX rate here, and then it just automatically translates the results into USD. And then to fill out the income statement, obviously there's a lot of line items here. We use basic ratio analysis, so you can see that I've got each one of those OPEX items as a percentage of revenue. And I just use the seasonality that we've seen in the past to estimate what the future periods are going to look like for those items. And then below that, we've got some non-GAAP adjustments. Stock-based compensation is somewhat easy to forecast. You can see that as a percentage of revenue, it's been about 12%. I'm using an estimate of the last 2-quarter average for stock-based comp as a percentage of revenue, and then I allocate it to each one of the expense line items based on the allocation that I saw in the previous quarter. So it's not really rocket science there. And then for the other items there, some of them are kind of difficult to project, and some of them tend to stay relatively constant, like depreciation or amortization. So I just set them equal to the prior quarter. The non-GAAP EBITDA reconciliation will populate itself because it's based on estimates from up above. And then we get some basic assumptions for changes in shares, and that is basically it. So that will fill in the income statement. So based on those assumptions, you can see that I've already calibrated the next 12-month revenue lines to be in line with consensus estimates, and then using my basic seasonality assumptions for the operating expense line items, I get back to the next 12-month consensus EP estimate as well. And then in terms of share valuation, I use a basic price earnings multiple on an ex cash basis. So I've adjusted cash to take out the net debt. And I'm just applying the average of the last 3 months to get back to the $96 price target, which is right about where shares are trading at this point heading into the release. And so I would say this model is relatively well calibrated, in line with consensus. You can put your own estimates in if you think that the company is going to grow faster or slower than I've presented here. But either way, when the results come out this week, we can fill in the December actuals, and we can keep the growth rates constant or change them if they have a really bad or a really good quarter, and we'll instantly see what the impact is on share price. So definitely check back, and when you fill in your blue cells and your estimates, if you'd like to submit the model, I'll post it on our website after reviewing it, and you can put some comments in for why you think the company will do what you think. And check back after the results are released. Thanks for watching.